Alright guys, so today I just want to quickly go through the idea of pricing structures and how the price of an item and how the item itself, how it flows through the different levels of the supply chain. It starts off with the manufacturer here who makes the item. They put a profit margin on and they can decide on the value of an item, which we spoke about in the last video. They put GST on there knowing that the government will be taking the GST eventually. When they get around to it, the GST will go to the government. And with the GST on top of that, that's the selling price to the next stage, which will be the wholesaler. They decide the value of the item based on the value of the item before, not the price that they actually paid for it. And that's used to calculate the 10% GST, which they know will go straight to the government. And then that decides on a selling price, which now the retailer is going to be paying. The retailer bases their calculations on the previous value to come up with their value level there. And that's what they calculate the 10% GST on, which they know will go to the government. So in the end, the GST that the government should collect in total will be $138, which the customer pays when they pay 1518 right at the end. Okay, and the customer doesn't have to deal with it anymore. Now, to make sure that the correct $138 is sent to the government in total by the businesses, piece by piece, we need to consider the idea of input tax credits. These are claims that each step in the chain can deduct from the amount of GST that they're collecting to bring to the government based on how much GST was paid by the previous step in the chain. So it ensures that it ensures that GST isn't paid twice. To stop GST being collected twice, and also ensures that only pay GST on what the business did, or their profit margin. Okay, so we can have a look at that. It's actually easier for us to have a look at the middle one first. Now let's have a look. The manufacturer collected $96 of GST, which the wholesaler paid in their cost price, and the manufacturer sent that $96 all the way to the government. Okay, so the manufacturer, as you can see here, manufacturer pays $96 straight up of GST to the taxation office. Now, when the wholesaler comes around and they need to pay GST to the taxation office, they need to realize that $96 was already paid by the manufacturer in GST, and they're collecting $120. So when the time comes for them to send the money to the government, they claim the input tax credit, pretty much represented by these yellow boxes on the right. They claim the input tax credit and subtract that from the $120 that they should be sending to the government. So in the end, they only actually send $24 of the GST they collected to the government. They keep the rest of it. Okay? So that is what ensures that the wholesaler, what did they do? All they did was collect the item. They bought the item from the manufacturer and held onto it in a warehouse somewhere. And they decided that service that they provide costs $240. And so 10% of $240 is $24. They only paid GST on their profit. Okay? And so you can see how that links on with the next bit. The retailer this time, they are going to collect $138 in GST from the customer who paid the GST, but they realize that the wholesaler collected $120 already. according to their calculations. So the retailer claims the input tax credit of $120, subtracts that from their $138 that they collected. So in the end, they only pay $18 to the government in GST, which, as before, is 10% of their profit margin. So there is a link of this being 10% of what they have done, the service that they have essentially provided. They have made the thing like the manufacturer. And that brings us to the idea of the manufacturer. Now, here you can see that the 160 profit margin is not it is not what is used to calculate 10% of the GST that's being sent to the government. But you can think of the manufacturer's large amount of GST going to the government in two different ways. You can either think of it as he doesn't have anyone previous to him that's already paid GST, so he pays the full GST that he calculated straight to the government. Okay, that's one way to think about it. And another way, it might not be completely right, but it can help you visualize if you think about it, is the manufacturer bought the goods that he used to make the thing, and he made them. Alright, so he did labor, and he basically paid for the parts. So you can think of that as he paid for the goods to make the stuff and the services, so he pays GST to the government in full for everything he did. He did a lot. He put it together and he paid for the stuff. These guys, yeah, they paid for the stuff, but all they did was hold on to it. These guys, all they did was hold on to it and sell it to the next person. So hopefully that explains why the manufacturers is a little different. I'd probably say that the easiest way to think of why the manufacturer pays more GST to the gov, because there's no other, because, that's the symbol for because there has not been any tax paid before them. So in the end, step by step from each business, the government gets one little piece. Well, that one's the bigger piece. One little piece that should add up to the $138 in GST that the customer pays in the end. And we see that I forgot my dollar sign. We see that is true. 96 plus $24 plus $18, that makes $138 GST collected over the three steps in the chain: the retailer, the wholesaler, the manufacturer, and that price, that GST, is borne solely by the consumer. Okay, they don't need to worry about collecting it. The businesses collect it and send it to the government. So hopefully that helps you with the pricing structures. They're not overly complicated, but you just need to understand where the money is going and how the prices are calculated. So hopefully that helps, and we can move on to the next topic.